Welcome back to Real Estate Mindset. And you guys, happy Friday. Hope you guys had a great 4th of July. Hopefully it was safe. Hopefully you guys enjoyed your family. I know that I did. And I wanted to show you guys before I really dug in here. And I'm going to give you guys a lot today. We're going to look at a lot of stuff. But take a look at this real quick, guys. I wanted to show you this poll. Maybe this is a sign that consumers really are in distress right now. I asked a question, do you plan on buying more than $200 worth of fireworks today? So I had 2,300 people vote on this, and only 7%. So it changed to 7% of people said yes. So I don't know about you guys, but I absolutely love 4th of July. I only spent $40 on fireworks this year because finances and inflation. So I don't know about you. Was that poll surprising? It was a shocker to me because, again, I absolutely love 4th of July. Don't you? But either way, you guys, we got the markets moving like crazy right now. We just had unemployment update. Unemployment did go up. Once again, we're at 4.1% unemployment. Once we go further on in this video and we get to the recession and liquidity indicators, I'm going to show you guys why, even though it says 4.1% unemployment, the trajectory, the direction that unemployment is going is spelling recession. Guys, come on. This is only going to end one way, right? You guys get that, right? I don't know exactly when is, we're going to swing that other pendulum. Things are going to fall apart, but it's going to happen. We know that. The proof is there, right? You could choose not to look at it. You could choose to look at it. I'm guessing, though, if you're watching my channel, watching my show, you guys are basically following all of the important data. So again, unemployment has gone up once again, and that has sent the 10-year, and I'll show you guys right now, that has sent the 10-year absolutely plummeting. Very interesting stuff. It went down to about 8 basis points. It's down 6 basis points now. So there is a lot of movement in the market. You guys can see when unemployment came out, again, it was up. When that came out, this dropped. So anytime they're making progress on the labor market or inflation, that 10-year is going to drop. But anytime inflation is carried away, that 10-year is going to go up. So that's why you see that going down. Unemployment's going up, in other words. And real quick, guys, good morning to everyone. Maverick was the first here. Good morning to you, Maverick. Vovo, I see you almost every video, Vovo. Appreciate your support. Appreciate everyone here. Again, appreciate you too, Greg. Hope you guys are doing well. I really want you guys to grow. I want to help create, I don't know how else to say this, but I want to help create some pretty solid buyers. I want you guys to be empowered citizens, empowered consumers. I've started really buckling down on making my real estate school where it helps consumers and citizens learn how to buy. So I've got a lot of good stuff coming. I know it's taking me some time, but anyways, guys, let's go into our mortgage update right now. Let me do my first timestamp. You guys can come back and watch this. It's going to be full of great stuff. But before we get started, again, I just wanted to say I appreciate you guys. I have my new studio here. I got 3 different scenes, so you guys will start seeing videos of my new studio. So other than that, guys, let's get ready to learn. All right, so we're going to start with our mortgage update. I want to cover a few bullet points before I go into the interest rates and the trajectory and what's going on there, because these are principles that I want everyone to learn. I don't care if you own 100 houses. I don't care if you've been renting for the last 20 years. These are fundamentals that everyone needs to understand, okay? And again, I know this because I'm a license holder of a loan officer and a realtor. So the number one thing I want you guys to always remember as far as principles, generally when you shop your mortgage with a broker, okay, not always, so generally you're going to get a better deal. All right. So just remember, generally you get a lower interest rate with a broker versus a direct lender. Number 2, I want you guys to remember, generally FHA mortgages, they have the lowest interest rate. Okay. So FHA has the lowest interest rates. Number 3, really the one advantage, again, these are fundamentals everyone should know about mortgages. One of the only advantages of conventional mortgages is the mortgage insurance goes away. That's pretty much the only advantage of conventional. It's just, and it doesn't even go away in all situations. It's just, it possibly goes away once you hit a certain amount of equity. Okay. So the other thing I want you guys to understand is, again, fundamentals, pay your amortization schedule down. If you don't do that, you will be trapped in debt for the rest of your life. A mortgage is like a debt prison. If you want to get out of that debt prison, you got to pay that amortization schedule down. Now, when it comes to shopping your loan, remember this, you guys. Okay, so when it comes to shopping loans, okay, this is how you shop your loan. Okay, so you're going to look at your interest rate, but on top of your interest rate, remember you're going to shop the closing costs. Now, what you're looking at right here, it's no longer there's no longer GFEs or good faith estimates. This is called a loan estimate. And don't get confused by looking at all these numbers. Remember, as a consumer, all you need to do is look at Section A, okay, which is basically the origination costs. So if you want to shop your lenders, you go interest rate, okay? So interest rate, and you check that loan estimate under Section A. And again, don't get confused with all the other nonsense back and forth and whatnot. You just need to compare apples to apples. Now, the other thing, guys, is remember, generally the higher your credit score, the lower your interest rate. So if your credit is, low 600s, mid 600s, you have time to increase your credit score, get yourself a better interest rate, and save yourself some money. So the better credit, generally, the lower interest rate, especially when it comes to conventional. The last thing, guys, okay? Actually, two more things, okay? Remember, when you have an inquiry, so when a mortgage lender runs your credit, you have a grace period of about, I think it's 4 weeks. It's either 2 weeks or 4 weeks to shop your mortgage without an additional inquiry harming your credit. So shop your mortgages. Now, the last thing I want you guys to remember is remember, it's about pricing. Interest rates are about the cost. So how much does it cost to get a 6%? Okay. So remember, you guys, it's not interest rates, it's the price. So if I wanted to lock in a 6% today, remember, okay, the price today, this is hypothetical, the price today, if I want to lock that in, it's $9,200. Why do you need to know this? Okay. Why am I telling you this? Is it just to hear myself talk? No, if I want to hear myself talk, I'll talk about fishing or something like super really cool. I'm telling you guys this because you need to have the ammo. I mean, look at the lawsuits that we have with the realtors. As consumers and as citizens, it's our time to shine. It's our time to step up. And we now know that no one's going to look after us. No one's going to get our back except us. And if you want to get your own back, listen to what I'm saying, okay? I've been doing this 2 decades and I've lost everything. And I've helped 1,000 people buy a house. Literally 1,000, probably over 1,000 people. You guys, I will never, ever lie to you. Okay, well, I make mistakes. Yeah, I'm a human being. I get emotional. I wear my heart on my shoulder, but I will not ever lie to you, and I will never milk you for all your money. You come here, my principle, my goal in this channel is to equip you. I want you guys to always leave with ammunition and with power, okay? I'm sorry for that. Those were the bullet points, though. So let's go back into the presentation. Okay, so here, once again, you guys, we're going to keep going on our mortgage update. So again, here's our 10-year. It's down 5 basis points. Watch this thing. Again, the market's not even open. I mean, we're starting early today. The reason I'm starting early is I'm going to do a project today for the case study new development we've been tracking. I'm going to go out and do that today. Here's where mortgage interest rates are at. So we're still in the 7%. Pay attention to the FHA. FHA being the lowest of all loans other than the 15-year. So FHA, government loans, VA, you're going to be in the 6%. Conventional, you're still in the 7%. If you've been listening to me, you guys do not forget, you should get a 0.5 point lower than what you see here by going where? A direct lender? Or what did I just say? A broker. Okay. Sometimes I can refer a broker. Usually I stay away from any referrals because I don't want to really be part of this housing market. It's so toxic, and I don't want to be responsible for anyone losing their house or financial ruin. So I have taken a massive break out of sales, and it hurts financially. It hurts me. You lose money teaching. But I mean, that's a legacy. When you make teachers, and I hope you guys are going to be teachers one day, I mean, that's a legacy. So anyways, guys, 7.08%. We're still in the 7%. Odds are when this updates today, even though this 10-year right now has dropped like this, rates are probably still going to be in 7%. So we'll update today. It's probably like 7.01 or something like that, but it's probably going to stay in 7%. We really don't see this going anywhere but staying above 6. So this is probably going to stay in 7%. Now, as far as the market's expectation on when are they going to cut the federal funds rate, okay? Not the 10-year, but here's CME Fed Watch. We know that the market's always overly optimistic. Literally, they're always overly optimistic. Now, the market has now guesstimated that the very first rate cut of 25 basis points is going to be in September. You see this right here? So they're saying 68% chance now, first rate cut in September. That's probably going to have a lot to do with the unemployment rate. Well, obviously they're tracking inflation. I guess they're tracking inflation, but really it's the unemployment rate. Now, if we go all the way to December, really nothing's changed too much, except for they are pricing in 3 rate cuts. They're saying it's more likely that there's going to be 3 rate cuts versus 1 rate cut, but the market is pricing in overall 2 rate cuts the remaining time of this year of 25 basis points. Again, 25 basis points, you guys, is almost completely useless. Now, if you're wondering, what's going on with mortgage purchase applications, well, it's worse than the great financial crisis. I repeat, again, when we hear people say, oh, the housing market's strong, the housing market's resilient, no, it's not. It's very unhealthy, and it's very toxic. And in fact, demand is worse. I repeat, demand is worse than the great financial crisis. So you can see here, the little gray part is the mortgage purchase applications. We're going back to the 1990s. Now, the thing is, guys, it's actually worse than the 1990s. You all know why? Population. Population's way bigger now, way more population right now than the 1990s. So the market is not resilient. The market is suffering and is falling apart, and it is not sustainable. I'll go over that here in a minute, but regardless, you guys, the market's in the gutter and demand is absolutely shot right now. And it's not just because of interest rates, and it's not just because of payments. It's because of the price. Okay. Now let's go to the amortization schedule. You guys know I love bringing you here because I do not want you to be a prisoner to a mortgage. I don't want you guys to be trapped to a mortgage. I mean, what's my purpose here? If you guys are just going to get your mortgage, you're not going to pay it off on time. I mean, you're not going to pay it down, then I have failed you as an influencer. If you guys are paying down your amortization schedule when you buy a house, then I have succeeded. Now, again, in case you haven't watched this part of the video, this is an amortization schedule. This is how mortgages are paid back. I put in a simple loan amount of $324,000 at today's interest rate, and over 30 years, you pay back in just fees $458,000. The total you pay back on $324,000 is $782,000. Now, I get people in the comment section say, "Oh, Travis, you just wasted $24,000 in rent." Well, so did you when you bought. You wasted $23,000 in interest, and you only paid down $3,200. I'm only saying you got to compare apples to apples here. You know what I'm saying? And don't just rush in to buy a house because your true interest rate is 150%. Okay, your true interest rate is 150%. But I wanted to put this in perspective for you guys. Okay, so this is year one. If you guys were to pay $3,200 down on your principal on year one, you would save $22,000 in interest. You pay down $3,200 in principal, you save yourself almost $23,000 in interest. Why wouldn't you want to do that? You guys see my point? You guys, if the banks, if you allow them, will profit off of you until your death. If you allow them, they will not say, "Hey, you know what? We've made a lot of money from you. We're going to give you a break. We're going to show some mercy." No, that's not how it works. If you keep your head in the sand, they will rob you. You must take your head out of the sand to protect yourself. I want you to pay you. Don't pay them. Pay you. Part of the way you pay you is getting out of debt. This is how you get out of debt with a mortgage. You pay that principal down. Trust me on that one, guys. Okay, it's very, very important stuff. So anyways, hope you guys like that. That was the mortgage app mortgage section there. So we went over the bullet points, went over a quick update. Let me see the 10-year real quick. Do we have any more? So 10 years still down about 6 basis points, not a lot. So we're going to listen to our first video, you guys. And this is basically Powell. This is going to be on Jerome Powell signaling that he's not going to lower interest rates just because of the election. So in other words, there's more pain to come. There's more pain to come because there's more inflation. There wasn't as much inflation and money printing, we would probably be well on our way to a crash or a reset, or rather a bust. But the inflation's here. It's going to be hard for quite some time. You know, take a listen to this video. You guys, there's no guessing games here. Oh my gosh, I got a super chat for $20. My man, marked for time, getting choked up here. It's hard times, brother. I really appreciate that support. I'm in the market for a new home due to me losing my job. Sorry to hear that, brother. And finding a new one in another city. I'm glad you found a new one. Your recommendation on asking what their par rate will save a ton of money, and the only way you directly compare rates. That's right. Okay, brother, you didn't have to spend $20 to get that message out there. That means so much to me, man. And I'm glad that you get that. And just to add to what he's saying, remember, compare the price of the interest rate and section A. Remember, mark for time, section A on the LE. And remember, LE stands for loan estimate, which took the place of a GFE, which is a good faith estimate. So the new good faith estimate, if you're old school like me, is the LE. So thanks, brother. It means a lot to me that you guys are learning, and also and the support is just it means a lot to me. I really appreciate that. So we're gonna listen to our first video right now, and you guys throw some comments below, and if you can, let me know that the audio is okay.
Partner and portfolio manager at DCLA and a CNBC contributor. Do you have any new views, sir? We're going to get some data later today on the path of the Fed, and how much does it even matter at this point to the way the equity market seems to be moving?
I think, Andrew, it's basically a call option, right? Powell's saying, hey, listen, if things slow down, we're here. And I think the tone is different from what we heard before, in the sense that, people were really afraid that, wait, maybe the Fed is going to raise rates or stay here consistently. And I think as we get closer to the year and you're seeing some of the economic data soften, once inflation data comes down a little bit, I think, the Fed will be in play. But he's basically signaling we'll be here, especially as we get through the election season.
And so your sense, though, just very in plain terms, 2024, does he move?
I think he only moves if you see economic data really changing. I don't think he's going to do anything because the economy is still strong and there's no need for him to do that. And I think once you start cutting rates, then the market starts looking forward and saying, wait, what are we missing, right? That first cut's going to be, what did we miss? And I think if you can stay here and rates can kind of come down where they have already in the 10-year, and you've got strong earnings, Andrew, the key is going to be next quarter's earnings now, because we've run up so far. Expectations are so high, especially for the high multiple stocks. So that is going to be interesting to see where companies come out, not just on the quarter, but what are they going to do? What are they going to say for the next couple of quarters?
And is your sense that, is your sense that when you think about where we are in this whole thing, he talks about we could be another year or two away from getting to 2%. I mean, the shift in terms of that timeline is somewhat surprising, given that people were talking about, 2 years ago, we were sitting here saying, can you really get to 2%? How can you get to 2%? How long is that going to take? You know what I mean?
Yeah, no, I think it's going to be longer than people expect. Inflation expectations in the economy are pretty high when you talk about labor and you talk about rents and input prices. So I do think the Fed needs to talk about it. If he says it's impossible to get there, then the market's not going to react, well to that. So I think this is that dance that he plays with the market. But at the same time, the economy is pretty strong in terms of earnings and companies, but you are seeing softening. So really, it's that call option. He's there to say, we will be here to save you, but we're not going to do it until we have to.
Okay. Any concern that we're in overvalued territory at this point in the ball game?
Oh, I do think if you look at kind of the overall valuation of the market and you break down the subsects, and we talk about this all the time, the big seven, the big five, they have to have really good earnings. So if you look at equal weighted indexes, I think that's where the opportunity is going to be in materials, industrials, select financials. These are companies trading at 10, 12 times earnings, when the rest of the market's trading at 21, 22. And you're getting earnings growth. It's not like you don't have earnings growth the rest of the sector. It's just the concentration has become so much. I think being in other places as well, I'm not saying don't be in the other ones, will be good for you as well.
Okay, if you're right, what do you like then?
So in commodities, copper companies, Freeport, Tech Resources. I think in industrials, you've got after suppliers like TransDigm, I think will do well in that area. And then if you want to talk financials, JP Morgan, Morgan Stanley, they just had buybacks, increased dividends. So you do see a bunch of companies there across select sectors. You're not just focused on, hey, are we just going to be on an AI play and how's that going to do? Because if AI works, which it hopefully does, all these other companies and other industries are going to benefit.
So what do you guys? Oh, Austin, dude, you changed your name and you changed your profile picture. I always struggle with that. All right, guys. So couple things. First of all, do you guys think that the markets are still overvalued? I mean, this is crazy. I want to throw up a couple comments before I go on to the real estate section, and I have a couple things I want to remind you as far as purchasing real estate. But I'm going to throw up Austin's comment first. I don't know why it took me so long to realize that was you, Austin. He's basically saying, what's the point of grasping for long-term gains and having negative cash flow and wedge? He's talking about purchasing an overpriced house. The thing is in my opinion, there is no point in doing that. If I have to rent another year, 2 years, then I'm going to do that versus purchasing an overvalued house. I've already purchased an overvalued house when I was a young adult. When I purchased an overvalued house, obviously I had bad spending habits. I know that, but I lost everything. I had a bankruptcy, I had a foreclosure, I had a repo, I had a tax lien. I lost my confidence. I was depressed, I had anxiety. I mean, it took me 9 years to rebound. These are things that I don't want you guys to go through. Thank God I can now talk about the situation and help others, but it was, in any ways, just listen to what he's saying. Don't just go run out and go buy a house. All right. You got to do it very carefully, or just wait. For the love of all that's holy, wait. Now, good comment here from Nikki. Economy is strong on headlines, but weak when peeling back the layers. I mean, it is so amazing to me how the headlines constantly say how great the economy is. But when we peel back, and we'll get to this section here in a minute, but when we peel back the layers, we have all of the historical precedent for recession incoming. It's all there. And so I honestly, I think people are crazy that think the economy is doing great. I mean, what about the deficit? Again, we'll get to that here in a minute, but we really got to pull back everything. Again, Mark, for time, I really appreciate you, brother. Thank you for that support. We're going to get on moving here to the real estate section. Now, before I go in here, a couple bullet points, just like the mortgage section, that I want to make sure that you guys as citizen consumers are understanding. Okay. So the first one is remember, you guys, real estate's all about hyper local subdivision review. In order to find out, and this is very simple math, in order to find out if a property has wedge or cash flow, all you guys got to do is a subdivision analysis. And I want to remind you guys, I made this form for you. This is for free. All you need to do is figure out the value for price per square foot, for rent, and for homes. And usually I go back 3 years. In other words, guys, I'll show you a lot when I have the school. We'll have a class on this, but this form is for you. I've done this multiple times. I have a playlist titled Value on my channel. You can go to that playlist. You can see how I fill this out, but just don't forget that you need to do subdivision analysis, and don't forget that I'm trying to give you tools to utilize, right? But I can't utilize that. I can't force you. You guys know what I mean? So, and another thing is always remember this. Let me pull up an appraisal. I want you guys to remember this as well. This is really important. Okay. So remember, value from an appraiser is generally determined by comparable sales. You guys, it takes 2 to 3 homes, comparable sales, to change the entire dynamic of a subdivision. So if you have 2 distressed properties in a neighborhood or 2 distressed properties in a subdivision, the entire value can be affected. I mean, here's an appraisal. You see that first column is a subject property, and then you have comps 1, 2, and 3. And then basically the appraiser does dollar for dollar adjustments based on property characteristics. Okay, so my point is 3 comps are used. They figure out the value of those 3 comps by comparing it to the subject property. Okay. But my point is like once the stuff hits the fan, it's really it's hard to stop, because once value starts going down, it just starts feeding it because the comparable data is. So remember, that worked in the opposite direction on the run up, right? The comps overvalued. Anytime someone would pay an appraisal gap, it would ruin the whole subdivision, right? Because now we have a comp that sold for above appraisal value. It wrecks the subdivision. So don't forget that. Now, also, you guys, don't forget this. Don't freaking rush. This is the biggest, and at this time, most risky financial transaction you can make. Stop rushing. Don't use your emotions. Okay. Now, the other thing, and no one's doing this. I don't like this. I understand it, but I don't like this. Okay. No one's doing this. While you're on the sideline, especially, find a great agent that is able to share the data with you. And if they don't, move on. Okay. Start testing agents. Have a list. Once we have the school started, I'll have forms for you guys to track. So I will give you guys forms eventually, but have a list and start finding realtors and start having them do a market analysis for you. Now, the other thing is remember this, every market is different. Okay. The other thing I want you guys to remember, and again, I feel like we're an extremely strong community. there are some markets where prices are going down, and there are some markets where prices are going up. Okay, you got to understand what's going on in your market, and you also have to understand that the data, a lot of the data is backward looking, lagging data that doesn't have the entire picture. So I would also encourage you guys to get out of your house, walk around and see what's going on. Are the houses vacant? How many homes does Open Door own, right? Like, see what's actually going on there. All right, so I'm going to move you guys on to you know what? I forgot to put an update here. I forgot to put a timestamp. I'm just going to put a 20-minute timestamp here. So what we're going to do now is we're going to go over a survey. So Black Knight came out with it. What's going on, Charlton? I see you, brother. Black Knight came out with this article right here. All right. So this is brand new. A couple cool things here, guys. So let's start right. Where do I want to start? Let's start right here. Because this is telling me that consumers are not doing the right thing. All right. So this is why I don't have faith in a lot of consumers. I have faith in you guys because you guys are trying to empower yourself, but I don't have faith for like normal people. So this is a survey questioning how many people, consumers that are looking to purchase a house, how many of them are shopping their lender. You guys, 36% aren't shopping. 1 out of 3 people are just taking the first rate that's given to them. Not all lenders are created equal. This is a horrible tragedy. What you see here is a tragedy. Do not fall into this. In fact, you guys, 84%, okay, 84% of people do not shop 3 lenders. Only 13% of people are doing what I'm suggesting. They are hurting themselves more than they can understand. If you go and shop and you get the wrong lender, you can pay $10, $20, $30, $40, $50,000 more over the life of the loan. It is so important that you shop your lender. I cannot express. I am a lender. I'm a loan officer. I am telling you, it's not equal. You have to find someone that works for you. Find someone that gives you the best deal. They are crooks. And another thing, a lot of them don't even know what they're talking about. So you got to really listen to me. Those 36% of people that picked the first lender, I'm telling you guys, probably 50, 60% of those people had to deal with a horrible loan officer. Okay, and they could have avoided that. So shop your mortgage. But can you believe that? Is that depressing or what? All right, let me go to page 8. Let me show you a couple things here as well. Okay. So this is very, very interesting, guys. I think you're going to like this. Now, this has to do with the golden handcuff effect. I'm trying to tell people, like, the golden handcuff is still strong. It is deteriorating a little bit, but let me give you guys a little bit of update for that golden handcuff effect. Now, bullet point number 2 says here, again, this is from Black Knight ICE. As of May, 24% of mortgage holders had a current interest rate of 5% or above. Remember how there's like no one had a 5% or above? Now, 24%. You guys, that's up from 10%. So again, in 2 years, we've more than doubled that. So that's good. The golden handcuff effect is breaking apart. But nevertheless, guys, it's still there. Now look at this, guys. All in, there are 5.8 million fewer mortgages with rates below 5% than there were 2 years ago. So 5.8 fewer. So the people that had those low rates, 5.8 million of them no longer have that super low interest rate. You guys hear what I'm saying? You guys, things are changing. This is only going to end one way. This is only going to end one way, in pain, in bust, price decline. It's going to end the same way it always ends. So we got to make sure, I got to make sure you're awake. That's my job. My job is to make sure you're awake. And not everyone is awake. Not everyone can even acknowledge the risk that I'm talking about. Bullet point number 5, there are now 4 million first loan mortgages originated since 2022 with rates above 6.5%. You guys, we now have 4 million households with rates above 6.5%. The golden handcuff effect is real, but it is unraveling. And you guys, I'm going to tell you, if rates plummeted today because of unemployment, we're going to have an influx of inventory. And we're going to go over inventory here in a minute. Let me go to page 13. This is a super cool report. I don't know if you guys check out Black Knight, but it's a real good stuff here. So, okay, so right here. So here's another part of a survey. I thought this was interesting because they're asking people, why are you currently renting? Okay, so I don't know if you guys know. Okay, so why are most people renting right now? So the number one reason, 40% of people that said they're renting because they cannot afford to buy a house. there's buyers on the sideline as well. But I want to make a point. There has always, since the dawn of since there were dinosaurs, there's always been people that wanted to buy a house that are stuck on the sideline. Always. There's nothing different about that. There's a flood of buying demand. If rates go down to 2% again, then yeah, and the government starts printing money and depositing into our accounts, then yeah, we'll have demand again. But my God. What I thought was interesting, though, is number two, 35% said they're happy renting. And the third, 33% said they haven't saved enough. So what did you guys say? About half of renters want to buy, I would say, roughly, right? All right, so let me show you the inventory now. This is crazy. Okay, so here's our inventory stuff. This is insane. The inventory growth right now, absolutely crazy. It's because interest rates are elevated, obviously unaffordability, quantitative tightening. But take a listen to this, guys. Inventory levels are at or above their 2017 to 2019 same month averages in one of every 5 major markets, with another 7 major markets within 10% of their pre-pandemic averages. Don't get stuck buying into the narrative that, we don't have enough houses. Okay. We don't have enough affordable houses. Okay. We have enough houses per se, but we don't have enough affordable houses. Now listen to this. These next 2 bullet points are going to blow you away. Okay. So 60% of the market where inventory has normalized are in Florida and Texas. I'm glad I'm in Texas. Now listen to this, guys. This is like shocking. Seriously, wrap your mind around this next thing. In fact, every major Florida market, I repeat, wrap your mind around this. Every major Florida market has seen inventory grow by at least 56% in 12 months. So tell me, why do people think we can't have an inventory explosion? If every single major metro area in Florida has gone up 56% in inventory in 12 months, where's the demand at? Where's the demand on the sideline? Where are the institutional investors? I mean, price cuts are historic. We have record-breaking price cuts right now. Where is the demand? It's not outpacing inventory growth. It's no longer the situation. Florida, the U-turn in Florida, guys. Keep your eyes on Florida. Keep your eyes on Florida. Let me go to page 15 real quick. Okay, take a look at this. This is more golden handcuff data. Okay, so this is more golden handcuff data. This is we're going to have like a triple whammy of events happen once we finally have the unemployment get out of control. This chart here is showing like the lack of new listings. So even though inventory is skyrocketing, like we just read, inventory is skyrocketing, there's still a whole bunch of inventory on the sideline, okay, because of interest rates. And you see it in these bars right here. Okay, so negative 31%, negative 25%, all of these downward bars are people, essentially, basically, are people that are waiting to not buy. Don't forget, there's a sideline seller as well. It's not just sideline buyers, y'all. We have sideline sellers. Now, personally, I haven't gone through this. Okay, the last time we had a rate lock-in effect was the 80s. I wasn't an adult. I don't know, right? So I'm assuming, I'm making guesses, I'm thinking, but nevertheless, we know there are people on the sideline that want to sell. So we have people want to buy, but we also have, look at all these people that want to sell. I thought that was an interesting set of data. I don't know what you guys think. Now take a look at this. This is crazy. This is on prices. Okay, so we're going to look at prices right now. Now this is, again, this is crazy to me because Texas flipped. So all the tracked metro areas in Texas this is month over month. Okay, so this is month over month, home price growth or decline. So Texas, every metro area, I mean, it is, peak buying season. So it makes sense because it's peak seasonality. It's peak. It's the hottest. So this makes sense, I'm saying. But look at this. So that rebounded, but look at Florida. Florida did the opposite direction. So Florida's down in multiple metro areas, again, in peak, super hot home buying season. Isn't it crazy, guys, how split everything is? In fact, they're saying, let's see, we have 3 metro areas. It's not even Texas. How is Texas not on here? The data is just so all over the place. This is why we can't trust the data. We really got to triangulate, look at multiple data sets, but we got 4 metro areas, major metros. We have Orlando down 0.02. We have Orlando, Tampa, and number 1, unbelievable, Miami. Number one is Miami, and Miami has one of the strongest new listing growths of all metro areas. Finally, Miami is going down. That's crazy, huh? You guys think that's crazy? I think that's crazy. Now the leading metro, let's see, where's the leading? Is Cleveland, Ohio still. Unbelievable. So Cleveland, Ohio is still doing its thing, you guys. Still doing its cleaning in Cleveland, Ohio. So that's going to do it for that section of this video. We're going to move on to our next video here, which is going to be about renting. It's going to be about the housing market. It's basically just going to empathize and sympathize with consumers and really talk about like how, yes, okay, first of all, when we compare new ownership to renting, so when we compare renting to buying right now, it has never been a bigger gap of benefit to rent versus own, because there's way more to own. However, it's still really unaffordable to rent, right? So even though I'm saying, oh, it's way better to rent, it's still really bad to rent right now. My God, guys, it's real bad right now. It's real bad. Anyways, I hope you like this video. If you guys can, and shoot up some comments. If you guys can, let me know that the audio is okay. I hope you enjoy the video. And by the way, oh my God, this is my original dude. This is my original first place champion, Deuster. All I'm going to say, man, I love you. I love you. I appreciate you, man. I'll never forget you. Here's the video.
Many renters are staying put, leading to price hikes for rent and complicating the overall inflation picture. Joining us right now is Igor Popov, Apartment List chief economist.
Hi, Igor.
Igor, good morning. Thank you for being with us.
Morning, Becky. Happy to be here.
Okay, so let's talk a little bit about this situation. We know the housing market has been really difficult. There has not been supply. That means people can't find houses to buy. That means they stay in their apartments. And that means that those rents have gone up because there's so much demand. What are you seeing right now nationwide?
Yeah, absolutely. The rents are up over 20% since the start of 2020. And in general, the rental market has just been on an absolute roller coaster since the start of the pandemic, really. Typical year rents grow maybe 3%, but we saw rent declines in 2020, skyrocketing rents in 2021 as we saw an explosion of housing demand, really tight supply, and then a real cooling housing market coming on the back half of 2022 with rate hikes and cooling consumer confidence. So that brings us to today. So nationally, we're tracking rents to be roughly flat, down a little bit year on year from last May. But it really depends on where you are in the country. We're seeing a lot of regional divergence. So we have some cool markets in the Sun Belt that are actually seeing rent drops. But if you're a renter in the Northeast or the Midwest, you're seeing some pretty strong rent growth this summer. So renters' experience of the housing market and the rental market in particular really depends on where they are right now. And one of the big drivers is really regional differences in construction right now.
Okay, so where there is additional construction, you don't have as much pressure on rent because there is new supply that's coming on?
Construction.
Absolutely. That's good news for renters. There is a lot of new supply coming on. So a couple of years ago, when housing demand was booming, interest rates were low, it was a pretty ripe time for developers to get in on new projects. But those projects have taken a while to hit the market. We actually entered the year with 1 million multifamily units under construction, which was a US record. And that's hitting the market now, but it's not evenly distributed. So a place like Austin, Texas is permitting 10 times as much new housing per capita as a metro like Cleveland or Chicago. And that's really driving the differences that we're seeing. Rents in Austin are down 7%. Places like Chicago, Providence, Cleveland, Milwaukee are seeing 3+% rent growth this summer as we enter kind of peak moving and leasing season.
Let's talk about what this means just in terms of the inflation picture, because the CPI looks at rent a little bit differently. How does it measure it?
Right. So there's really two different stories when we look at market rents and the average rents that Americans are paying, which is really how we measure rent for the purposes of tracking inflation. And so market rents move quickly. They can turn on a dime. The rents that average Americans are paying, they move slowly because most folks are locked into 12-month leases. And as a result, the CPI, the rent measurements that factor into the consumer price index, they lag what we see in the market by really over a year. And so CPI rents are really a shadow of market rents. They're still tracking the deceleration that we were seeing last year in rent growth. And so this creates a pretty tough picture for the Federal Reserve, because I think there's a feeling that the housing market has already cooled significantly from rate hikes, but we don't really get the full scorecard until CPI rents catch up to the market. And they're cooling in the CPI, but it's going down very slowly. It's like watching paint dry, and we keep waiting for the CPI rents to come down. They're coming down, but very slowly. And what we're seeing now in the market, if we're seeing a new rebound, and I think we're seeing a new rebound in demand across the country, that again is going to factor into CPI rents 4 to 6 quarters down the line. And I think the bigger concern is that as rents stay higher for longer, that now we're actually seeing suppressed construction, which is ultimately the big story for the housing market over the long run. Is, can we get enough housing units onto the market to give renters some relief?
I mean, it follows new construction, right? It follows new construction. Do you guys hear that Austin's down 10%? I'm sorry. Austin's down 7% year over year for rent. I mean, that's huge. We're going to go on to our recession and liquidity indicators, but a couple comments I wanted to throw up here. I got a question from Charlton Zimmerman. His question is see Raynell's, see you Raynell. So this is Charlton's question. Why can't you buy a single family home, turn it around and rent it out? Do you really need permission from the lender? So do you need permission? So you don't need permission per se, but Charlton, when you purchase a house, you must be honest with the lender. And if you're going to purchase a house based on it being a rental, you have to say, I'm going to purchase a house, but I'm not going to live there. If you're going to buy a house and you're not going to live there, it's called non-owner occupied. So NOO, so non-owner occupied. When you have a non-owner occupied loan, the interest rate's higher, the down payment is more. So you have to indicate that, or it could be a felony, right? It's mortgage fraud. So you have to indicate that. Now, if you purchase a property as your primary residence, technically, I believe the rule is you have to live there for 1 year, and then you can convert it to a rental. There's no inspection that's done, right? So generally the lender is not going to go drive out to your house to make sure you're adhering to that. My point is don't lie. Don't ever lie when it comes to doing a mortgage. It's a felony. So don't ever put yourself in that situation. Always be honest. But there's a grace period that's a year that basically says, Charlton, you got to live there for 1 year, and then you can convert that sucker to a rental. Good question. Let's see here. I got a couple more questions, guys, real quick. Here's another one right here. But if prices fall, will it increase the chances of you selling or decrease? It depends what the purposes of someone selling, and it depends how much equity. So if you purchase 2022 and on and prices fall, you're stuck anyways. I mean, you're stuck. But if you're one of the buyers 2022, if prices fall 10, 15%, there's still a lot of people that have equity. Like, that's what I'm trying to explain. Like, we could take a hit. If you purchased in 2018, you can lose 15 to 20% of equity and be perfectly okay. So the lower rates would encourage me to sell potentially. But again, if prices go down and you've recently bought, you can't do anything. You can't sell. You can't refinance without having to bring money to the table. This is a good comment from Nikki. He was talking to Deuster. He's disagreeing with something Deuster was saying, but basically he's saying once homeowners lose their homestead, then they lose house. Then their house is no longer cash flow and are back on the market. So basically, if you have a primary residence and you were to like I had a primary residence, I kind of was forced to be a landlord. I didn't necessarily want to be one. I have a homestead on my property. My homestead gives me property tax protection, but when I convert it to a non-owner occupied, remember NOO, non-owner occupied, I lose the homestead protection and my property taxes can skyrocket upward. And when my property taxes skyrocket upward, that reduces my cash flow. And a lot of investors are feeling that, especially in places like Texas, where property taxes are just, I'm just at a loss for words how bad it is in my market as far as like over assessing and things like that. I mean, it's really, really, really bad. All right, guys. So let's see here. So what are we going to do now? Let's go into our This one's going to be crazy. We're going to go into recession liquidity indicators. Let me start by showing you guys the first indicator. Let me look at the 10-year real quick. What are we at in the 10-year? So it made a little bit of rebound. So I want to show you guys the first recessionary indicator. So let's go over indicators first, starting with unemployment. Now, a lot of people are going off of the 10 and the 2. We'll look at that in a minute. Now, here's the unemployment rate. This is not updated from this morning. This has gone up. But what I'm doing, guys, is I put a star next to any time that unemployment goes up. So we're looking now at the trajectory, the direction of unemployment. We're not looking necessarily at the rate of 4.1. We're looking at what's going on with the labor market. Is it healthy? Is it not? And remember, you guys, this is with a whole bunch of government jobs, part-time jobs, delayed data, manipulated data, massive revisions. But nevertheless, unemployment is going up. You see, anytime that happens, literally going back to the 70s and 60s, anytime that happens to this extent, we go into recession. This is probably, from my opinion, because recession is about unemployment, this is probably the strongest indicator right here. And literally, again, it does not go up unless we go into recession. Test me on that. Go to this form and check that out for yourself. But again, that's a huge indicator. Okay, so that's one indicator. Here's a second indicator right here. This is the yield curve inversion. This is one of the most trusted recessionary indicators out there because it takes a whole bunch of data and it puts it into one set. So a lot of people trust this because it's one set of data and it's warning us pain is coming. This is our forefathers, our ancestors. This is the market saying we're going into recession. We don't care what the headlines say. We're gonna act like everything's okay, but we're gonna put our money where our mouth is. And when we put our money where our mouth is, when we're putting that money where our mouth is, we are going into recession. That is what they're saying right there. And we have been inverted since April 1st of 2022. We've been inverted we started inversion, 2 years and 3 months, longest inversion in history because of the inflation. So again, those are two indicators. If we don't go into recession, this will be the first time in history. Like the two indicators I just showed you, strongest indicators. We don't even need to look at anything else. The pain is coming. This is only going to end one way. People are going to get hurt, especially people that are not prepared. Even the people that are prepared are going to get hurt. But nevertheless, the 10 and 2 inversion, guys. This is huge. But another indicator that our economy is horrible is this bad boy right here. So I roll my eyes. Oh, the economy's doing great. I see in the comment section. I mean, I don't even respond anymore. I mean, if it's nonsense, I would just keep it going, How can people say our economy is strong when we're printing as much deficit, when we're doing as much deficit spending as the great financial crisis, and we're not even in recession? We have spent, this is not total, this is just year to date, and its fiscal year starts October. We're at 1.2 trillion. In 2009, recession, Great Recession, it was 1.4 trillion. So we're going to pass that this year, and we're supposed to have this great economy. Great economies don't have that. That's another indicator. We're barely hanging on, guys. Barely hanging on. But let's look at some more stuff. Here's another indicator, okay? Again, I'm trying to explain. Let's forward look, okay? Because this is a lot of lagging data here. What you guys see here, this is a huge component to prices going down. This is when people, consumers, citizens stop paying their bills. This is the delinquency rate of credit cards. You may just, if you're just going to glance at it, and if you're not going to dig in and really look at this data, you'll be like, oh, 3.16%. Yeah, it's a 10-year high, 15-year high, but still pretty low. We're fine. Yeah, maybe. But what I'm pointing out is the trajectory. Look back. We're going back to 1992. When it goes up, it's bad things happen, you guys. The trajectory of delinquencies is skyrocketing. Okay, so that's another indicator. When citizens and consumers cannot pay their bills, the banking sector, the financing sector, it all falls apart. So people are not paying their debt. Okay, so this is the debt. People are suffering. They're not paying. But on top of that, the personal savings rate is in the gutter, 3.9%. I mean, this is almost historically low. The last time it was this low was during, you guys probably guessed it, the GFC. The great financial crisis. So people are behind on their credit cards. They can no longer save money because the cost to live, for one thing, and again, real adjusted for inflation, income went down. People can't save. People are behind on their bills, and income is not keeping up with the cost to live, which is why it's not sustainable. Now, in case you're wondering what I'm talking about, when I'm saying it's not sustainable, what do I mean? We're in a double bubble. It's not just we're in a housing market bubble or an everything bubble. It's a double bubble. it's a double bubble. You can see that here when we overlay Case-Shiller home prices over CPI. You guys see, okay, here's the GFC, okay, when it peaked right there, and then look, it got grounded again. Things got more reasonable, okay? But look at right here, guys, when it started really kind of breaking apart, separating, and that bubble started getting bigger right here, the Federal Reserve started doing quantitative tightening. Go back, look at 2017 to 2018. You will see the Federal Reserve started increasing the federal funds rate, and they started doing quantitative tightening in the form of selling mortgage-backed securities because of the bubble right here. Okay, so they, again, I could prove this. Go back, look at the federal funds rate, look at mortgage-backed securities. They were trying to slow things down, okay? But instead of it slowing down, instead of busting that bubble, we just got another second bubble. I'm just saying, we're in a double bubble. And it's not like, you guys know that video game back in the day, by the way? All right, anyways, moving on to the liquidity. Okay, so why haven't we gone into recession yet? Right? People are like, Chavis, you've been talking about this for 2 years. Well, how long have they been doing quantitative tightening, haters? For 2 years. I've literally been doing this about, 3 weeks before quantitative tightening. If you're wondering how long I've been doing this, I'm tracking quantitative tightening. I mean, seriously, before quantitative tightening, I was like a bum realtor doing, the top 5 places to live in Houston and the pros and cons of living in Houston, and call me, I'm a realtor, I'm great. That's what I used to do when I believed in real estate, which I no longer do. Okay, so I'm just saying. But anyways, guys, here's the overnight reverse repo market. This is the liquidity. This is just money in the market. This is the suspension system. But this is part of the reason why we have not gone into recession. We have $425 billion in inflation. Can we call that inflation? I think we can. Okay, on top of that, mortgage-backed securities, we still got 2.3 trillion. And this is what I mean. Look at, so this is when see this going down. This is quantitative tightening. See, and look at, they started this in 2017. Do you guys see? So again, they're trying to tamper down that bubble right here. You see this, they're tampering down that bubble. And then instead of that, boom, they screwed us instead. But nevertheless, they are winding down. They're still doing quantitative tightening, but you guys, they got a long way to go. They still got 2.3 trillion. The Fed has complete control, not complete control, but they got a lot of control over the markets. Here's a Treasury general account. So not only all that money, here's more inflation. Just showing you guys the inflation, like why is this taking so long? $765 billion of the Treasury account. They can spend that whenever they want. Also M2. M2 has been going up since November. I'd say November of 2023. It's about right here. So M2 is trending up. M2 is a total money supply. So, we have that liquidity. We have these inflationary pressures that, it's going to take a great deal of pain. All right. Now let's do our last video real quick, guys. This is going to be on the payroll data. So the labor market's all over the place. Where do we go to get the data? These bulls are still being recklessly optimistic, but listen to what they're saying, and then we'll get you guys out of here. I really appreciate you guys. I hope you guys enjoy this video.
Stay with us. Let's bring in ADP Chief Economist Neela Richardson. If I was going to look for a report to sort of just confirm what recent reports have been indicating, I guess this would kind of be it. Any major divergences from what you were expecting, Neela?
No, this has been a very modulated cool down. The labor market is striking the right note at the right time to be consistent with that gradual easing that's consistent with the 2% inflation target. The concern, and this is one concern we have, is how concentrated these job gains are. As Steve mentioned, they're in the service sector. The leisure and hospitality sector is carrying 40% of the job gains this month. And so while we think that this is a gradual cool down that we all expected, I'd like to see the hiring be more broad-based than it is now.
Neela, the details in the numbers, does it make you think that the progress on inflation that we've seen recently, can that continue, or could we get stuck?
Leisure and hospitality, the labor market more broadly has really helped the Fed. It's helped the Fed be patient. It's kept its pace and then gradually cooled again at the right time. But if you look at those paychecks and the fact that we've broken 5% year over year growth with this highly strategic, individualized match data set, that is important. The last time we were under 5% was in August of 2021. So this pay growth, the fact that it is slowing in a modulated way, is so important for the Fed. I think it is the most important data point right now.
Would you change any of your expectations for what we're going to see on Friday based on the details here?
I think it's harder to predict what's going on in the BLS report. One, government jobs have really been strong in that report the last couple of months. So will that continue? Healthcare has been, again, picked up very strongly in that report. This is a sector that is not as sensitive to interest rates, so we may see that again. But what you really, I think, is worth paying attention to is the unemployment rate. How cool is cool enough for the Fed, and how fast is that unemployment rate going to rise, or is it going to stall? I think that's the key question going into Friday after we all have a break on Thursday.
Steve?
Hey, yeah, Joe, I just want to point out when you're talking about with Neil about wage gains, the rate of decline, and this kind of highlights the Fed's problem. It's true of inflation overall, and it's true of wages. It's really flattened out, right? So you went from 5.8 or so back in October of 23 down to 5 real quickly. And in the last 4 months, we've gone from 5 to 4.9. So there's not been all that much progress. It's going, as Neil has said, in the right direction, but it's kind of like what's happened with the overall inflation rate, which is you had these big drops in the second half of 23, and now the drops have moderated. And what's interesting, though, about what Neil is saying, I don't see, Joe, how you get, if these numbers are right, 150,000, there shouldn't be much rise at all in the unemployment rate from there.
Neil?
Yeah, just to continue with that line of thinking, we did see percentage point declines last year in year-over-year pay growth for job stayers. We're not seeing that anymore. It's edging down. And our contention when we look at the data is it's likely not to get back down to pre-pandemic levels. The economy has shifted. The demographics are not in the favor of seeing year-over-year pay gains around 2 or 3%. So if you think of a world in the future where year-over-year pay gains are elevated, it does make the job harder for the Fed. They can't rely on basically flat year-over-year gains in some industries. That's not happening.
All right.
Alrighty, then I accidentally deleted that video. Oh my god, I shouldn't have done that because I have to put it in the description to give credit to the source of the information. So I'll have to go get that in a minute. All right, guys, let's see here. What else do we got? I want to give you a couple questions I want to put up. I want to give you an update again. I'll be working on those courses and the school this month. I plan on doing 2 to 3 live courses every single week, and we're just going to go over everything there is to buy, how to improve yourself as a consumer, just basically the pitfalls. And it's going to be a school. I'm going to be a teacher, and I'm actually excited about it. I'm overwhelmed because it's a lot of responsibility, but I'm going to make a school, and it's going to be for you guys. And let me know, is that something you guys are interested in? You guys are interested? You guys going to come to school if I do that? I'm going to do 2 to 3 live classes. We're going to go over industry secrets. We go all that stuff. I'm going to be going all out for you guys. And then after I'm done here, guys, I'm going to go to the case study. I'm going to film that, see where that's at. That's the Silverthorne new subdivision. I'll check that out. I don't think it's going to do well. Let me see if there's any comments real quick. I think I start a couple here. First one's from House Hacker. I like House Hacker personally. He's a veteran as well. He served our country. If you're buying a house, plan on keeping it for a long term. So I just wanted to bring that up. So I'm not saying that concept is not right. That concept is correct, right? If you're going to buy a house, think long term. My concern, House Hacker, is like, okay, I'll use myself as an example. When I had my foreclosure in Southern California, I planned on keeping the house forever. I did not plan on losing my job. I did not plan on having a foreclosure. I didn't see that coming. And my worry, House Hacker, is like the kids, right? Not like you. You chose to purchase a property based on fundamentals, but a lot of these kids, millennials, things like that, they don't even understand what an overvalued house is. And so they don't know how to prepare for turmoil. And I believe that there's going to be a portion of people that even though they planned on keeping for the long term, they can't. They're not going to be able to afford to. That's my worry. But you're not wrong. You know, it's not like buying a pair of shoes you could just like return at the store. You guys know what I'm talking about? People are buying with 3% down payments and promises to refi from their realtor later. I mean, that's horrible, you guys. I mean, you can plan on, you know, like when I do my workups and my numbers and my cash flow and my wedge and all that, honestly, okay, listen to what I'm saying. I'm a seasoned expert. I plan on refinancing for sure. Like what I'm doing now, purchasing, you guys don't listen to what I'm saying here. I plan on refinancing, and I'm buying when I buy my next property, it will be bought as if I'm going to refinance in the next year. I mean, that's how I'm doing it. So I'm not saying you shouldn't do that, but what I am saying is I will not buy a house though unless I can comfortably afford the house. So I don't need to refinance. I'm just like, if I refinance, this is what I expect to happen. So don't get caught in that, guys. Don't get caught in that. My thing is like, don't rush it. Make sure you can afford it, whatever the rate is right now. Okay, and that's what I would do. John, I don't know why are you making fun of people, John? Why are you making fun of people, man? Does that make you, why are you making fun of people? And then our last thing, doom and gloom every episode, quit crying about the market. Just, I mean, these are the comments we get. I mean, who are you? I'm going to tell you who this is. This is some dude that's filthy rich that thinks he's better than everyone else because he's got more money than everyone else and can go buy a house. But the reality is this show's not for you. Mr. Cigars, it's not for you. And no one's crying. What we're trying to do here is we're trying to empower each other, grow as a community. You can actually, you know what, Mr. Cigars, come on over to the community. You're welcome here. It's just these comments are weird. Why are you watching it? I mean, I see someone crying. I see it's you that's crying. But that's all right. You know what? I'm not going to delete comments. I'm not going to censor. If you guys want to cry in the comment section, it's your God-given right to do it. Go cry in the comment section, but don't ask me to respect you. I think it's nonsense. I think you're a little child, you're a little baby. I mean, help some people. I mean, you're balling, you're in tropical paradise smoking cigars. Help some people, brother. That's how you give back to society. That's what life's about. It's about relationships. It's about the way you live it. It's not about money. Your money's not keeping you comfortable. Is it? Is your money keeping you comfortable? Is it talking to you? Is it holding you to sleep? Is it rubbing your head and saying, "Are you okay?" Is it giving you aspirin at night? You're probably taking one aspirin a day, but it doesn't matter. My point is, it's all right. I get it. If people are frustrated in the comment section, whatever, it is what it is, but we can't censor each other. All right. We can't do it. If people want to grovel, just look at it for what it is. They want to cry. I mean, generally when people are offending you or trying to offend other people, it's what they're going through. And we could probably distinguish that guy's probably not in a good place. Or maybe he is. Who cares? My point is, if you can, and this is to you, Cigar, let's not create division. Let's create unity. Even if you offended me, Cigar. You just offended me, but I don't care, brother. I'm a grown man. I want you in our community. Because when you're not, all that's going to happen is we're going to drift further and further apart. That is what the elites want us to do. That's what society wants us to do. The more divided we are, you guys, the more money they make. The more unified we are, the stronger we are. And so that's what I'm saying, man. You know what? I don't even care anymore. Like, keep offending me. And you guys probably see in the comments, I don't care. Offend me if you want. I still have all of the stuff linked in my description. I still have my free home buying course. I still have my free subdivision analysis form. I'm still going to make my school, and I'm not going to quit, and I'm not going to give up on you, and I'm still going to be forthcoming, transparent, and honest. Didn't I tell you guys that's all you need to be successful in real estate? Just be honest. Anyways, I appreciate you guys. Happy Friday. Be safe out there. Don't get drunk. Be careful for the double bubble. Let me know if you guys like this. Share the video. Comment below when I'm done here. I appreciate you. I love you. Thank you for all the support. Go in the Discord community. We're going to try to do a members live on Sunday. I just don't know if there's enough time. I'll be in Discord. I'll talk to you guys about that. I really appreciate you guys. And if you're out there investing in real estate, you guys already know. I wish you luck, and I hope you win.